producer, and they saw actually decent margins across the board because we saw less subsidies. So they've got an outperform rating on that one. And finally, Sinopec, which is one of the biggest oil and gas corporations, that stock is down 1.31. But that probably has more to do with the fact that oil prices are a little bit sluggish here. But Citi is still bullish on the stock, and they say that they're adjusting up their forecast for the next 3 years because they're assuming higher oil prices by over the next 3 years, and they'll say that domestic production should be able to recover from 2014. Back to you guys.
Okay, all right, Adam, thank you so much for that. We're going to turn our focus now to capital raising. Twitter just pricing its IPO, valuing the company at around about $11 billion. There's also another mega listing that everyone is anticipating, and that is, of course, Alibaba. Some news out on that this morning. And now with the whole crowdfunding issue, it's making sourcing capital just a bit more interesting. For a closer look on how the cash-raising side of the market is working, let's talk to Stephen Nash. He's the co-head of OTCQX Group at Cohen & Company. Stephen, how are you doing?
I'm excellent. How are you?
Good. Good to see you here in Sydney.
Thank you.
Alibaba, this is interesting. I mean, you know, yes, we're talking about Hong Kong, then we're talking about the US, now we're talking about the possibility of Hong Kong again.
Right. Right, and it could be just some gesturing, right, and back and forth between the U.S. and Hong Kong to get what they want, which is an ownership structure that allows a very small few to control this very large company.
And as you were talking to me about during the break, it's a similar ownership structure to what you can already see in the U.S.
Well, you can synthetically create a similar ownership type structure that allows for control to be housed in a few or within a few number of people. For example, Facebook had this dual shares of stock where the preferred is largely dominated by one Mark Zuckerberg. Same with Google. Google has two classes of stock. The preferred, again, being the majority control, and many of the founders being heavy in that stock. So you look at Alibaba, for example, that we have the Gang of 28, that collectively own 10% of the company, really wanting to remain in control of what ends up happening. So the pushback in Hong Kong, I think, was very much to say that, no, we're not allowing that in this market. The U.S. actually is okay with it because we have precedent for it.
Bernie.
Steve, Bernie. Yeah, Bernie up here in Hong Kong. Isn't that a bit of a problem? I mean, there's so much global, worldwide collaboration and cooperation and synchronization on so many other things, like, FinReg, they're starting to get around to it. Accounting standards, that's still a bit of a ball of wax. But, I mean, we were talking about it in Hong Kong this morning. You tell me if I'm totally flat out wrong. I don't mind if you say that. But, I mean, when you have Jack Ma and his lieutenants kind of shopping around, sniffing around the aisles of different supermarkets, trying to find out where they can maintain ironclad control, I mean, doesn't that, open the door to riding roughshod over the minorities down the line? I mean, the whole reason that, the Jardine Group got out of Hong Kong is they didn't like the takeover code, so they went to Singapore, where it was perceived as more lax, and now the Kazakhs have a dual company structure that is so convoluted that nobody could ever take them out of office, I mean, I don't think it's right. What do you think?
Right. I think what you're seeing is a preference among entrepreneurial companies and to retain control of their baby, and that is and it happens from very small companies to very large ones. Now the question is it a bad thing? I'm not necessarily sure it's a bad thing. It's what these companies want, and you as an investor can always choose not to invest in the company. So it'll be interesting to see if these companies where they've synthetically separated the control component of the equity from the ownership component of the equity start to trade at a discount because you don't have as large of a say as you otherwise potentially could in a simple structure, which seems to now no longer be the fad.
Right. In the case of the Hong Kong exchange operators, I'm no defender of them. Steve, I mean, this is a market which is so, is so contrived with their 7 layers of fees, including, you buy a stock and you have to line the pockets of the SFC here with the SFC enforcement levy. And one of the dumbest things in a market like this is the stamp duty. I mean, it makes a dent in government revenues, but what it does is it keeps the, it keeps the dark pool operators, the liquid nets of the world, out of the market. Hence, the volumes in this market are just sagging compared to other places that have embraced the fact that these people who will come to your market and create, a vortex of volume, this is good for you. This puts you on the map instead of letting you wither away. I mean, I don't hold them blameless at all.
Bernie, I couldn't agree with you more. I couldn't agree with you more. And that is really making trading more efficient is really what the world is demanding. It's what institutions are demanding. Whether you like it or not, high-frequency trading is here to stay. Institutions care about their execution costs, and any dime or penny or half of or fraction thereof that you add to transaction costs really can be to the market's detriment. So arguably, as markets get more efficient in trading, you would likely see institutional capital want to flock to markets that don't have those costly components, which is frankly what we're seeing.
Okay. All right, Stephen, we are out of time. It's been great to have you with us.
Thank you for having me.
Thanks for joining us today. Stephen Nash with us there from Cohen & Company. Well, coming up, Japan is inflating steadily in the yen, going along for the ride. Paul Mackel from HSBC with his outlook on the currency when we come back.